You've got $100,000 to invest, but here's the big question. What's better, consistent dividends or explosive growth? Here's the truth. Picking one without fully understanding the trade-offs can cost you hundreds of thousands or even millions of dollars over time. SCHD and SCHG are both powerful ETFs, but their paths to wealth couldn't be more different. In this video, I'll show you and John the differences between these two ETFs, covering their strategies for generating returns and the potential risks involved. Each aspect will be broken down to give you a clear understanding of which ETF might better suit your investment goals. And in the end, I'll show you and John a side-by-side comparison of investing $100,000 in each ETF over the long term. One ETF has the potential to reach an over $8 million valuation, while the other will pay over $30,000 in monthly dividend income. Let's kick things off by getting to know our contenders, SCHD and SCHG. These two ETFs might sound similar, but they play entirely different games in investing. First up, we have SCHD, the Schwab U.S. Dividend Equity ETF. This one's for the investors who value consistency, income, and a little peace of mind. SCHD is laser-focused on dividend-paying stocks, companies with a track record of steady payouts and solid performance. Launched back in 2011, SCHD has become a favorite for those who want a low-cost, income-focused ETF. Its expense ratio is a mere 0.06% and has a massive $66.11 billion in assets under management. On the other side, we have SCHG, the Schwab U.S. Large Cap Growth ETF. If SCHD is the dependable one, SCHG is the ambitious one chasing big dreams. It's all about high-growth companies that are reinvesting profits to scale faster. SCHG leans heavily into tech and consumer cyclical sectors, basically the high flyers of the market. Since its inception in 2009, SCHG has carved a niche for aggressive growth investors. Its expense ratio is even lower at 0.04%, and it currently manages $37.15 billion in assets under management. Okay, so now that we've covered who these ETFs are built for, let's take a closer look at what's inside. Starting with SCHD, the Dividend King. SCHD invests in companies that are not just paying dividends, but growing them consistently. Its top holdings include giants like Pfizer, Coca-Cola, AbbVie, and Chevron. These companies are household names, and for a good reason. They're reliable cash generators that have weathered market storms. SCHD's portfolio is heavy on financials, healthcare, and consumer defensive stocks, with smaller slices in industrials and energy. This broad exposure gives SCHD a level of stability that dividend lovers crave. Its 103 total holdings keep it diversified, but here's a fun fact. The top 10 holdings account for 40.99% of the entire fund. That is concentration with intention. SCHD's managers want to ensure those high-quality names pull their weight. Now let's look at SCHG, the growth-focused ETF. Its top holdings include well-known names like Apple, Microsoft, Nvidia, and Amazon. These are companies that prioritize reinvesting profits to scale, aligning with SCHG's focus on capital appreciation. SCHG holds 229 stocks, but its top 10 holdings make up 61.18% of the fund, showing strong concentration in market leaders. This approach works well for investors looking for focused exposure to high-growth companies. In terms of sector allocation, technology leads with 49.63%, followed by consumer cyclical and communication services. This weighting towards growth-heavy industries explains why SCHG tends to perform strongly in bull markets when these sectors thrive. That said, this heavy focus on tech can be a double-edged sword. On one hand, it's driven incredible returns during bull markets, but on the other, it makes these funds more vulnerable to market downturns, especially if the tech sector takes a hit. Understanding performance is crucial when choosing between SCHD and SCHG. While both ETFs deliver solid results, their paths to success are very different. Let's start with SCHD. Over the past year, SCHD returned a respectable 9.96%. It's not flashy, but it highlights SCHD's focus on consistent, reliable growth. SCHG, however, delivered an impressive 34.18%, significantly outpacing SCHD. This reflects SCHG's growth-oriented strategy and its reliance on high-growth sectors like technology and consumer cyclical industries. Looking at the 5-year period, SCHD grew by 42.31%, providing steady returns through a combination of dividends and price appreciation. Meanwhile, SCHG's growth soared to 132.88%. And over the past decade, SCHD delivered total growth of 108.44%, more than doubling an initial investment with a balance of moderate price gains and strong dividend payouts. By comparison, SCHG's performance skyrocketed to 330.26%, driven by its heavy allocation to high-growth companies. That's a clear win for SCHG here, but there's more to the story. SCHD's returns include a steady stream of dividend income, which adds another layer of value, particularly for investors who reinvest their dividends. In the end, I'll show how other factors of these ETFs can significantly impact the final value, resulting in a difference of $4 million and $350,000 in annual dividends. Now let's take a closer look at volatility. SCHD has a lower beta, meaning it tends to experience smaller price swings compared to the broader market. This makes it a safer choice during downturns. SCHG, on the other hand, with its higher beta, is more volatile but offers higher potential rewards during bull markets. In fact, when it comes to dividends, SCHD and SCHG take very different approaches. Dividends are a cornerstone of SCHD's strategy, while SCHG focuses more on growth. SCHD is a dividend investor's dream. It has a current dividend yield of 3.61%, which is significantly higher than the market average. This yield, combined with an impressive dividend growth rate of 11.04%, makes SCHD a strategic tool for generating income. Over time, this income can compound, especially if dividends are reinvested. Meanwhile, SCHG isn't designed for dividend seekers. Its current dividend yield is just 0.42% with a modest dividend growth rate of 5.1%. This low yield reflects its focus on reinvesting profits into high-growth companies rather than distributing earnings to shareholders. Now, when comparing ETFs, expense ratios are a crucial factor to consider as well. Even a small difference in fees can significantly impact your long-term returns. Fortunately, both SCHD and SCHG are extremely cost-efficient, but let's break down how they stack up. Starting with SCHD. Its expense ratio is 0.06%. That's just $6 per year on a $10,000 investment. For an ETF focused on delivering high dividends and steady returns, this low cost makes sure that more of your money stays invested and working for you. That said, SCHG takes the lead in cost efficiency with an even lower expense ratio of 0.04%, only $4 per year on a $10,000 investment. For a growth-oriented ETF where compounding plays a critical role, this minimal fee helps maximize your portfolio's potential. In the end, both ETFs are incredibly low-cost options. Now it's time to put the numbers to the test with a side-by-side projection. This is where we see just how much John and your $100,000 investment could grow in SCHD versus SCHG over the long haul. Both ETFs have unique strengths, but their long-term outcomes have a clear picture of just how differently they perform. Starting with SCHD, with a current dividend yield of 3.61%, a solid dividend growth rate of 11.04%, and an average annual share price appreciation of 7.81%, SCHD offers a balanced approach. After 1 year, your $100,000 investment would grow to $111,418, combining modest price growth and dividends. Over the next decade, your investment triples in value, reaching $310,310. At 20 years, the portfolio will cross the $1 million mark and reach $1,106,378 thanks to compounding returns and reinvested dividends. By the 30-year milestone, the initial $100,000 investment will be valued at a solid $4,759,480. One of SCHD's standout features is its dividend income. After 30 years, the annual dividend payout will be $369,779, equating to about $30,815 per month. The total value added by SCHD over 30 years includes $2,369,900 in capital appreciation and $2,289,580 in reinvested dividends. Of course, the question is, can SCHG beat that? Let's break it down. With a lower dividend yield of just 0.42%, a dividend growth rate of 5.1%, and a much stronger average annual share price appreciation of 15.93%, SCHG focuses on reinvesting profits to drive portfolio value. After 1 year, the $100,000 investment will grow to $116,350, outpacing SCHD's returns in the short term. By the 10-year mark, the portfolio accelerates to $448,597, showing the power of SCHG's growth-oriented strategy. At 20 years, the portfolio reaches a valuation of $1,981,361, and by the end of 30 years, SCHG delivers a staggering $8,708,090 in total value, fueled by its emphasis on high-growth stocks. However, SCHG's focus on growth comes with a trade-off. Its dividend income remains minimal, with just $1,136 in annual dividends after 30 years. The total value added by SCHG over 30 years includes $8,586,296, with the majority portion in capital appreciation and only $21,794 in reinvested dividends. Now that we've covered the details, let's focus on what really matters. Which ETF is the right choice for your investment goals? For stability and income, SCHD is ideal. Its 3.61% dividend yield and 11.04% dividend growth rate can generate nearly $31,000 per month in dividends after 30 years, making it perfect for retirees or income-focused investors. With lower volatility and diversified holdings, it's a safer option during market downturns. If you're focused on growth, SCHG is your go-to. With 15.93% annual price appreciation, it can turn $100,000 into $8.7 million over 30 years. While its dividends are minimal, its emphasis on capital appreciation makes it a strong choice for long-term investors willing to handle volatility. Look, both ETFs are excellent. Choose the one that fits your strategy. Want to know which is better between QQQ and QQQM? Click the video on the screen to find out which one can outperform SCHG by $5 million.